It's easy to make mistakes when you're new to investing or managing your own money since there are many confusing things about the business. Whether your goal is to trade actively or to purchase stocks for long-term holding, there are a few mistakes new investors make that they repeat too frequently. The most common among these is not understanding what represents value in a stock and what is considered quote-unquote cheap and expensive. Hello everyone and welcome back to the Finance Guardian channel. In one of his famous quotations, Oscar Wilde said that the problem with young people was that they know the price of everything but the value of nothing. Since then, every generation has echoed these sentiments to a certain degree. A lot of investors are also guilty of this early on in their involvement in the market. Price and value are two separate things, and price is only relevant when it is viewed in the context of value. When you examine a stock's value, you are able to see if its current price is cheap or expensive. This can help you decide if it is worth investing in. Finding the stock price is simple. Determining its value, though, is a little bit more complex. Still, it's not impossible, even for the average investor. Interested in knowing how? Hit that subscribe button and the bell beside it, and let's go ahead and get started. Why do stocks have values assigned to them? A stock's intrinsic value, as defined by their underlying business fundamentals, is not always the same as their current market price, despite what some people believe. It's important for investors to assign values to stocks because it helps them decide whether or not to invest in them, but there is no single way to value a stock. Active investors who believe that they can devise and execute investing strategies that outperform the market value stocks based on the notion that a stock's intrinsic value is entirely independent of its market price. Active investors use a number of metrics to estimate a stock's intrinsic value and then compare that value to the stock's current market price. Passive investors, on the other hand, adhere to the efficient market hypothesis, which posits that a stock's market price is always equal to its intrinsic value. In the view of passive investors, all available information about a stock has already been priced in, so its price is a true reflection of its value. Adherents of the efficient market hypothesis often recommend investing in index funds or exchange-traded funds (ETFs) rather than trying to outsmart the market. The cornerstone metric for valuing stocks is the price-to-earnings (PE) ratio. The most common method for valuing a stock is to compute the company's price-to-earnings P/E ratio. The P/E ratio is calculated by dividing the company's stock price by its most recently reported earnings per share (EPS). Having a low P/E ratio implies that investors buying the stock will receive an attractive amount of value. Let's take Walmart as an example and calculate its P/E ratio. During the company's 2021 fiscal year that ended on January 31st, 2021, diluted earnings per share were $4.75. As of this writing, the company's share price stands at $139.78. To calculate Walmart's P/E ratio, simply divide its stock price by its earnings per share. Taking $139.78 and dividing that by $4.75 yields a P/E ratio of 29.43 for the retail giant. GAAP earnings versus adjusted earnings for calculating P/E ratio. GAAP is short for Generally Accepted Accounting Principles, and a company's GAAP earnings are its earnings reported in conformity with them. Earnings in GAAP measure profitability on an unadjusted basis, that is, without accounting for one-off or unusual events, such as purchasing a business unit or receiving tax incentives. The majority of financial websites report P/E ratios using GAAP-compliant earnings figures. Non-repeating events can increase or decrease a company's profits to such an extent that some investors prefer to calculate a company's P/E ratio using a per-share earnings number adjusted for the effects of one-time events. P/E ratios tend to be more accurate when adjusted earnings numbers are used. To continue with the Walmart example, its P/E ratio of 29.43 is calculated using its unadjusted GAAP earnings of $4.75. As indicated in the company's fourth quarter earnings report, adjusted earnings per share for the same period is $5.48. This adjusted figure takes into account losses associated with its Japan and United Kingdom operations, gains on equity investments, and the impact of restructuring charges. Using Walmart's adjusted EPS value, we can calculate its P/E ratio to be 25.50, which comes from dividing the share price of $139.78 into $5.48. What is the best P/E ratio for a stock? A P/E ratio that is attractive to one investor may not be so to another. Investors may view P/E ratios differently depending on their investment objectives, which may be more oriented towards growth or value. Value investors are naturally attracted to low P/E ratios. They're likely to invest in stocks with market valuations substantially below their intrinsic value. Growth investors typically favor stocks with a high to P/E ratio because they believe that the superior rate of earnings growth, if not the absolute value of the earnings themselves, justifies the high P/E ratio. What investors can do with variations of the P/E ratio? Investors, particularly growth-oriented ones, often calculate two other metrics based on a company's current and past P/E ratios: the forward-looking P/E ratio and the price-to-earnings to growth ratio (PEG). Forward P/E ratios are easy to calculate. Using the P/E ratio formula, stock price divided by earnings per share, the forward P/E ratio replaces the EPS from the trailing 12 months with the EPS projected for the following fiscal year. Financial analysts and sometimes even companies themselves provide projections of EPS. The PEG ratio represents the rate at which earnings are growing for a company. It's calculated by dividing the company's P/E by its estimated growth rate of earnings. Most investors focus on a company's projected growth rate over the upcoming 5 years, but you can consider projected growth for any period of time. PEG ratios are more reliable when growth rates are projected for shorter periods of time. Continuing with our Walmart example, analysts predict that EPS will grow by 6.29% per year over the next 5 years. When Walmart's P/E ratio of 29.43 is divided by 6.29, it creates a PEG ratio of 4.67. Stocks with a PEG ratio below 1.00 are considered exceptionally valuable because of their high growth projections. Some other valuation metrics. There are numerous methods for estimating a stock's value, with some better suited to certain types of companies than others. Price to sales ratio. In addition to the P/E ratio, the price to sales ratio, P2S, is another common metric used to value stocks. Essentially, the P/S ratio is equal to the market capitalization of the company, which is calculated by dividing the total value of all outstanding shares by its annual revenue. Due to the P/S ratio's focus on revenue rather than earnings, it is used extensively to evaluate public companies that are not yet profitable and do not yet have earnings. Walmart and other stable companies with consistent earnings are rarely measured by the P/S ratio. Since Amazon has historically shown inconsistency in earnings growth, investors remain more inclined to use the P/S ratio when evaluating the online retailer. Currently, Amazon has a market cap of $1.7 trillion and revenue of $386 billion for fiscal year 2020. When $1.7 trillion is divided into $386 billion, you get a P/S ratio of 4.4 for Amazon. It's important for investors who wish to compare the P/S ratios of different companies to compare only those companies with similar business models. P/S ratios can vary greatly across industries due to their vastly different sales volumes. Typically, companies operating in industries with low profit margins must generate large volumes of sales. Price to book ratio. Price to book ratio is another useful metric for evaluating a stock or company. Price refers to the stock price of a company, and book refers to its book value per share. The book value of a company is equal to its assets minus its liabilities. Asset and liability numbers can be found on companies' balance sheets. The book value per share of a company is simply equal to its book value divided by the number of outstanding shares. Price-to-book ratios are only marginally useful for evaluating companies with asset-light business models like software tech companies. A metric such as this is best suited to evaluating asset-heavy businesses such as banks and other financial institutions. The value trap. As business conditions deteriorate, a stock can appear cheap, but it's actually not. Such stocks are known as value traps. value traps can arise in the form of pharmaceutical company stocks with an expiring valuable patent, cyclical stocks at the peak of the cycle, or tech company stocks whose once innovative offerings are being commoditized. Other factors to consider when valuing a stock. Aside from quantitative metrics such as the P/E ratio, investors must also consider qualitative factors such as a company's strengths and weaknesses to evaluate a stock's value. Companies with a defensible economic moat are better able to compete with new market participants, while companies with large user bases are able to reap the benefits of network effects. Companies with a relative cost advantage will be more profitable, and those in industries with high switching costs should find it easier to retain customers. High-quality companies tend to have several intangible assets of considerable value, such as patents, regulations, and brand recognition. The legendary investor Warren Buffett once said, quote, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." And that is all the time that we have today, folks. We hope you enjoyed this video, and if you did, please do remember to hit that like button. If you're new around here, subscribe to our channel, and on your way out, please do remember to click on that bell icon too so you can remain updated about all of our future videos. You're welcome to the channel where you will learn the basics of personal finance in easy to understand language. We'll see you next time.